We're now going to talk about another tax planning technique. And as I mentioned earlier, the non-resident aliens and foreign corporations only pay tax on their U.S. source income. So consequently, they pay tax in the smaller tax brackets until they have a lot of U.S. source income. They pay tax in a smaller tax bracket than a typical American would pay tax, because if an American rents out a piece of real estate and then has other income, their other income will push their real estate rental profits into a higher tax bracket. But if the foreigners start off in a very low tax bracket and they're not making a lot of U.S. rental income, they'll stay in a low tax bracket. Well, we want to make sure that when foreign investors come here, if there's a group of them, instead of putting all of them in a single corporation so that that single corporation makes all of the money and has higher and higher tax rates because the single corporation is making a lot of money, we are able to take that group of foreign investors and put them in a partnership. And each one of the foreign investors in the partnership will then be subject to tax only on their individual share of whatever that partnership made. So instead of having a single corporation making $100,000, paying in the tax bracket that apply to $100,000, you may have 10 foreigners. If they are in a partnership, each one of them pays only on each one owns 10%, they pay only on their 10% of their income. Each one would pay only on $10,000 of income and stay in a very low tax bracket. So what we use in those situations is we establish a partnership. A partnership is an entity where each individual partner is subject to their individual taxes on partnership earnings. And that is the way to keep everybody in the lowest tax brackets, by picking up their own individual earnings as opposed to a share of a larger portion of earnings.